The 7% rule that protects every smart investor, but almost nobody uses it. Did you know that one single rule could protect your entire stock portfolio, and most people ignore it? Imagine this. You've just bought a promising stock. It looked perfect. Great company, solid earnings, everyone's hyped. Then, 2 weeks later, boom, it drops 15%, and you're stuck, hoping it comes back. If that sounds familiar, you're not alone. But professional investors don't hope, they follow the 7% rule. And today, I'll show you what the 7% rule really is, where it comes from, when to use it, and how it can save your money, or even make you a better investor. The 7% rule isn't some mysterious Wall Street trick. It's actually one of the most tested, time-proven strategies used by successful investors, including those who follow the legendary methods of William J. O'Neill, the founder of Investors Business Daily and author of How to Make Money in Stocks. O'Neill studied thousands of stock market winners and discovered something fascinating. The biggest mistake investors make isn't buying the wrong stock, it's not selling when things go wrong. And that's where the 7% rule comes in. The 7% rule is simple. Whenever you buy a stock, set a stop-loss limit at 7% to 8% below your purchase price. That means if the stock drops more than 7% from where you bought it, you sell it. No emotion, no hesitation, just sell. Why 7%? Because research shows that if a stock falls that much, the odds are much higher that the trend has turned against you, and you're better off protecting your capital than waiting and hoping for a rebound. It's like an emergency brake for your portfolio, automatic protection when things go wrong. The 7% rule wasn't invented overnight. It comes from decades of real-world data. O'Neill and his team studied over 100 years of market history and found that the best-performing stocks rarely fall more than 7–8% below their breakout point before rising again. So, if a stock does drop more than that, it's probably not one of those big winners. It's simple statistics. Cut your losses early and let your winners grow. That's why it's one of the most trusted rules among growth investors worldwide. When to apply the 7% rule. Here's how to use it. When you buy a stock, immediately set a stop-loss order, 7% below your entry price. Example, you buy Apple at $100. You place a stop-loss at 93s. If the stock goes up, you can move your stop-loss higher to lock in profits. But if it falls to 93, you sell, no questions asked. This protects you from devastating losses and keeps your mindset clear. Because remember, even the best investors are wrong some of the time. The difference is, they lose small and win big. Pros and cons. Let's talk about the good and the bad. Pros. It limits your losses automatically. It removes emotion from investing. It helps you stay disciplined. It keeps your capital safe for the next opportunity. Cons. In very volatile markets, the stock might drop 7% briefly and then bounce back. It may cause overtrading if used too aggressively. It's not ideal for long-term dividend or value investors. It works best for active traders or growth investors. But the truth is, for small investors, the 7% rule can mean the difference between a small loss today and a disaster tomorrow. For whom is it useful? If you're a beginner, this rule gives you a structure. If you're an experienced trader, it keeps your ego in check. If you're a long-term investor, it can help protect your short-term plays. In other words, it's a universal shield for your portfolio. It's not about being perfect. It's about surviving and compounding. So the next time you buy a stock, remember this. The moment you buy, also plan how to sell. That's the heart of the 7% rule, discipline over emotion. And if you want to understand why the market moves the way it does and how big investors shape those trends, make sure to check out my next video. How the stock market really works. It'll change the way you see every price chart forever. If this video helped you, hit like, subscribe, and share it with someone who needs a little less emotion and a little more logic in their investments. Remember, smart investing isn't about luck, it's about rules. And now you've just learned one of the smartest.